Welcome to our 2025 Business and Economic Outlook webinar. My name's Michael Pollock. I'm the Head of Media and Communications here at Creditor Watch, and I'm happy to say I'm joined today by Ivan Colquhoun, our Chief Economist. Hello, Ivan. Welcome.
Good morning.
So Ivan has a bunch of juicy insights for you today to give you a pretty comprehensive outlook of what to expect across 2025, the economic outlook and the business outlook. Before we get started, just a couple of things for the people who aren't probably that familiar with what we do at Creditor Watch. We are Australia's only commercial-only credit reporting bureau. So we have a complete suite of products that runs the gamut from onboarding to collections, an end-to-end ecosystem credit management. We were founded in 2010 and with around 4 employees. Our CEO, Patrick Coughlin, was one of the founding employees. We now have more than 250 employees across Australia and New Zealand with just over 60,000 customers. So we're growing pretty strongly. Next slide there, please, Ivan. So as I mentioned, the 3 main strands of what we offer are onboarding, customer management and collection. So we have automated onboarding tools that help you cut down the time it takes to onboard customers so you can trade more quickly, you can do more precise due diligence, doing away with paper referrals and things like that. And then we have monitoring tools so that you have a complete picture of the health of your trading partners, and you can be automatically alerted when adverse information changes. That then feeds through to our collections tools, which are again automated to help increase your collections rate. Our automated reminder notices increase your chance of getting paid by around 57%. And it's particularly helpful at this time of year when a lot of businesses have an increase in revenue. They have a pickup in business over the Christmas period, but the collections team or the receivables team is pulling their hair out trying to chase all the payments. So this our Creditor Watch Collect tool in particular really helps you manage that without having to increase your headcount and collect all the revenue that's owed to you. And next slide, please, Ivan. And just finally, so we have approximately 50 public and private data sources that we draw from. So we have a daily feed from ASIC that sends us the insolvency data. We also have our own data on defaults and insolvencies, credit inquiries, which are lookups on our system, is another one. And then we also have accounting software integrations that give us around 11 million trade lines between Australian businesses. So we have a very comprehensive data suite that we showcase every month in our Business Risk Index. The November results for the Business Risk Index will be out next Thursday, so look out for that. All right, let's move on to today's webinar. Look, Australian businesses are doing it really tough at the moment, as many of you would know. I hate to use the term, but it's probably been a perfect storm in terms of high inflation, the higher interest rate regime. We've seen wage increases this year, and then coupled with declining consumer demand, have all conspired to create a really tough environment for Australian businesses. What does the outlook look like for next year? Well, that's where I hand over to this man, Ivan Colquhoun, our Chief Economist, who has been looking very closely at all of the data and is going to share with you right now a lot of his insights. Over to you, Ivan.
Thanks, Michael. Good morning, everyone. So what I normally start about is just thinking about some of the really big trends that will affect the economy over the next 10 to 20 years, because that's when you're in business. Obviously, I'll talk a lot about the ups and downs of the cycle in the next 12 months and 18 months. But these are some of the things that are going on that will shape how things evolve over 10 to 20 years. So I came up with, I think, pretty obviously when I asked people in more intimate and interactive settings, they all come up with technology, ageing population, geopolitics, climate change. Everyone comes up with those pretty quickly. Cybercrime comes up a bit, but I think that's part of technology. And I think the fifth biggest trend is the rise of inequality. I think that drives a lot of things. It's probably an interaction of technology and politics. I did ask ChatGPT for what it thinks is the top 5. It put the first 4, but it had globalisation still. So let's keep those in mind. Those are themes that will run through the next 10 or 20 years, not just the next few years. And they create opportunities. If you're in technology, it's very strong. Aged care is obviously a very strong sector as well, but also threats. I mean, technology can threaten some businesses, and just listening to Michael's introduction, it's interesting to see Creditor Watch really harnessing all the technology there as well. I think when you are trying to look at the future, you always need to have a good idea about the starting point. The starting point was really the last few years. COVID was a huge shock. It was a complex shock, and it had some very big forces happening. You think about lockdowns and the changes that made to working from home. That's rolled into the number of times people visit CBDs. It's got impacts for office space. It's actually changed the housing market a lot. People have, or through COVID, they wanted an extra room. And then, of course, there was that big shift in spending to goods. So all of that came from lockdowns. Then we had the border closures, which affected migration, students, and obviously international travel. We had zero interest rates for a while. We had very significant fiscal support to businesses and consumers, and that meant there were very few insolvencies through that period, and despite a lot of pressure. So all of those came together. They produced really significant imbalances in goods markets, the supply chain disruptions, in labour markets where unemployment was really, really low, and no matter how much you advertised, you couldn't find anyone. And then in housing markets, the vacancy rate fell, even though there was very little migration and students went home. So very complex starting point, and I'll show you what I think the big forces are going forward now. Now,
Ivan,
just showing.
If I could just jump in quickly. I forgot to mention at the start, if anybody has some questions that they'd like to send through for Ivan, just chuck them into the chat and we'll get to them if we can.
Yeah. So thinking about those distortions or the imbalances, and this is what the Reserve Bank's trying to do with its interest rate policy. It's trying to correct those imbalances. And at the same time, the federal government is trying to also manage the cost of living and the impacts that are falling on probably a lot of people that are least able to deal with that. So again, this complex situation is still running through. So if you look at the goods markets, those supply chain distortions, there's a measure the New York Fed puts out. It's saying they're largely back to normal. Probably if you look at shipping costs, not totally back to normal, but those distortions to shipping costs that we saw through that peak period of supply chain disruptions have obviously subsided. What's happening now is obviously the effects from the Middle East wars and the actual time and extra distance that a lot of freight has to take coming from Europe, and that ripples through the whole supply chain. So will that be as long lasting? If we see ceasefires in the Middle East, then I think that can be significantly reduced. But I thought it would go completely back to normal. I think the geopolitics story says probably we shouldn't be expecting it to be as normal as or as sustained a good period as we saw before. The labour market, unemployment and underemployment is much lower than it was before COVID. That's a good thing, unambiguously a good thing. It's still quite hard to find labour in a number of sectors, and that's much tighter than it was before COVID. So that adjustment isn't there. It's keeping some pressure on wages, and that's a factor in when you think about when interest rates may be reduced. And then the housing market, again, you can also see it's much tighter than it was before COVID. The vacancy rate's quite low. Its turnover has slowed a bit from those peak levels where houses were flying, but it seems to be rising a little bit at the moment, but it's not in every city. Sydney and Melbourne in particular, probably a bit slower. Perth, Brisbane, Adelaide, still very strong, I think. So we're making progress, but I think we need to think about those rebalancing theories or changes before the Reserve Bank's going to be cutting interest rates. Now, when you think about the Reserve Bank, the main focus for them is getting inflation back to target, to this 2.5% target. Now, 2.5% is this Goldilocks, not too hot, not too cold rate of inflation. People can deal with prices going up at 2.5% a year. At the moment, we're still recording more like 3.5% a year. And we haven't, if you just look at the red line, we haven't seen that much progress, sorry, the blue line, we haven't seen that much progress this year. So the RBA still wants to get greater confidence that inflation's coming down. And that's going to be key for when interest rates come down in Australia. Now, I think this is really important, and a lot of people don't quite realise this. If you get inflation, or if the RBA gets inflation back to 2.5%, it does not mean that prices have gone back to where they were. This chart shows that, in fact, prices will just be rising at a slower rate from that much higher price level. So the cost of doing business, the cost at which people are selling products, for most products, they stay higher permanently, but they then grow at that slower rate. So this is why we've found these challenges. The cost of living is so much higher. When you go through the supermarket shelves or you go out to dinner, you notice that prices are much higher. And when you're running a business, I think you notice that your input costs are much higher. So that says don't expect that to fully reverse. Just be planning. I've been suggesting to customers, try and push back on price increases. And businesses, try not to push your prices up as much, because that will help the RBA reduce interest rates earlier, I think. So
if I could
looking forward,
sorry, Ivan, if I could just jump in with a question there. So based on jumping back to interest rates, what would be what's your current view on when we might see interest rate relief for businesses?
I think, look, somewhere between February and May. February is the earliest. They won't do anything next week. Then May, if they wait to see 2 CPIs. So it'll be February to May next year. I'm still confident we will get interest rate relief next year because inflation is moderating. The economy is reasonably growing slowly, as we saw yesterday. But I'm not expecting a lot of interest rate relief. I think if we saw rates down 0.5% to 1%, I think that's about as much as we can really expect. And I would also point out that we don't want to see interest rates coming down a lot. Typically, when that happens, it's when we have a bad economy. So it would be good, and I'm going to suggest that we are going to have a soft landing, where interest rates will only come down a little bit, but they will help there. So I think when you look at the big forces for the next 12 months, these are the big factors. So we still have to deal for the next 3 to 6 months with high interest rates. We will have to deal in an ongoing sense from these high inflation rates. So I think you have to look at pushing back on cost increases, trying to find some productivity improvements if you can. I think the tax cuts are helping a bit, but that's one big block of forces. Then there's all those mega trends I spoke about, and really a big new force, and one that I think creates a lot of uncertainty, particularly if you're in manufacturing, transport and logistics, retail to a certain extent as well, is Mr. Trump's policies. So these tariff policies are very, very big, and much bigger than they were last time around when he was putting on selective tariffs particularly on China, but only on selected goods. Now, if you put a tariff on, that pushes up prices. So remember, central banks look at inflation. That's a key part of interest rate changes. And they will push up measured US inflation. And they will also, and have been already, pushing up the US dollar. And that's been creating a weaker Aussie dollar. Now, there's some good things. He's planning to cut the company tax rate, but less so than he did last time around. So I don't think that will be as big. But that's a big uncertainty for businesses and for inflation as well. And then, of course, we're running into the next federal election, which is always an uncertainty. And the parties are much closer than they were 6 to 12 months ago. So a change in government to a Liberal minority government is a possibility. And of course, their energy policies are quite different, and their climate policies are different as well. So a lot going on, some COVID after effects there as well, almost, but not quite going to drop those from the big forces. So with all those going on, I think you have to be a bit cautious about listening to economists, and when economists sound very confident, be cautious, because those are all big forces, and it's hard to get them all correct. Now, looking at the world for a quick period of time, the US economy is doing quite well. That's very good. Whenever the US economy is doing well, it's good for the world. Now, again, Trump's policies, I think, probably act to slow growth, but we're starting from a good place with the US economy. Other more manufacturing-focused economies, like China and Germany in particular, they're not doing as well. And a lot of manufacturing actually did very well during COVID when we had those big when we were locked down, there was a surge in demand for goods. So there's a little bit of pull forward there. There's going to be that uncertainty from Mr. Trump. And then, of course, manufacturing is quite impacted by interest rates. Some manufacturing is discretionary. Housing is affected by higher interest rates. And that's part of this weaker manufacturing story. And then the other side, if we look at some of these really tech-focused economies like South Korea, Taiwan, compared to where they were before 2020, very strong volumes of exports, volumes of semiconductor and electronics. So it's a very mixed economy, manufacturing weak, but electronics and technology doing very well. And you can see that when you think about, okay, we've got to deal with high interest rates, but we've got this AI boom. So again, that complexity showing through. So what do I do when I have all these different forces, I tend to go back and rely on a couple of my favourite indicators that add up all these conflicting forces and give you a net result. And one of the best I've found is job advertisements. And I plotted them inverse here, but you can see the blue line, when it rises sharply, which means less job ads, unemployment always rises. At the moment, it's actually just, I don't know if you can see the cursor that I'm moving. That's the important trend. It's gradually slowing. Can you see the cursor? Yeah. So that's the trend. This trend here was actually when the borders reopened and a lot of people, migrants and students came back, backpackers. So that was extra supply of labour. I think this trend is a slowing demand for labour. And when that happens, we always see lower interest rates. So that's why I'm still confident rates will come down. It also means the unemployment rate will probably continue to drift a bit higher. The second favourite indicator is the NAB Business Survey. You can see these very weak periods of the economy when business conditions are at -10s. At the moment, we're about 7. That's about average. But it's quite different depending on what city we're talking about. So when we look at it, retail, trade and manufacturing, again, a consistent story there with rates and some pull forward of demand during COVID. A week, some of the services sectors and mining tend to be outperforming, and finance so far is holding up pretty well. So a very varied economy by sector.
Ivan, just a quick question on the economy as a whole. Where are you seeing the green shoots? The there's a lot of doom and gloom out there, but where are the good news stories, if there are any?
Look, I think there's some good news stories. Like, there are pressures, but so far, most businesses and most consumers are handling them pretty well. The unemployment rate is still at 4.1. It was 5.25 before COVID. So that's a good story. Business conditions overall are okay. I can see a little bit of more encouraging signs in housing, which I'll show you shortly. And I think this is a good sign. Consumers are feeling better about the economy. They're not positive yet, but they're a lot less negative than they were. So I think that's the income tax cuts that were flowing through from 1st of July, starting to come into the economy. So that's a good thing. I think if I jump through here, I can see you can see that slight trend improvement in approvals to build detached houses. Now, still not a super high rate, but it's beginning to recover. We're starting to see perhaps an improvement in big apartment dwellings. So those are both green shoots. And if I look overseas, I can also see in the US that the manufacturing data may be starting to move up as well, and there's not as much high inventory. So all of those things are moving in a way that suggests the economy probably isn't quite as challenged as it has been, but we need to see rates come down, and obviously they've come down in the US already, and probably will come down next month or this month, later this month. But there's that uncertainty from President Trump's policies going forward. And then I guess
on the other side of the coin, then, what are your, I guess, biggest concerns about the Australian economy? What are the roadblocks to recovery that you're concerned about?
Well, I think a headwind will be that population growth is going to slow. Government's put in place trends for that, reducing migration, tightening up on students. I think that's a bad policy, restricting the number of foreign students. They should have, in my opinion, tightened made it harder for foreign students to stay in Australia after they finish, but not stop them coming. That isn't a smart policy. What else? I think you can always generally say tax reform isn't very good in Australia. Income taxes are too high. GST is too low. That may not be popular with everyone, but we need to rebalance the tax system. There's too much tax on income now and not enough on spending. And if we look finishing up on the NAB business survey, South Australia, Tassie and Victoria probably the weakest states at the moment. Queensland has been outperforming, and New South Wales and Western Australia about average. So what about what people are forecasting at the moment? This is a lot of numbers, I've just realised. But what it says is that the weakest GDP, that number is now 0.8 rather than 1 in the top left-hand corner after the data yesterday. But we're at the weakest point for growth according to the RBA and economists. That slow growth and high interest rates is enough to bring inflation back down to target next year. It's enough to mean that unemployment goes up, but not very far, and that interest rates can come down over the next 12 months by 0.5 to 1% to get us all nicely back into balance. Now, these forecasts were all made before President Trump was elected, so perhaps inflation won't be quite as good. Interest rates may not fall quite as far, and the Aussie dollar won't be quite as strong as those forecasts suggest. But it is a soft landing rather than a recession. And that's really important for business, because when we have recessions, that's when all the damage gets done to economies and to social structures and to businesses. So that's a good thing. Just finishing up with a few of our indicators that Michael mentioned. So we track payment defaults. So this is when two businesses, or a business that is registered with Creditor Watch, reports that another business isn't paying it. And the trend there, it's picked up quite strongly in the last few months. So watching that quite closely. Because that suggests maybe there is a bit more pressure. If that trend kept rising sharply, to me that would say interest rates are going to be cut earlier. That will show up in the economy in various indicators. And we can look at it by different sectors, and these are not numbers, they're indexes. So you can see that the most challenged sectors recently have been construction and food and beverage services, so your hospitality industries. Interestingly, the last few months, hospitality, both much higher than pre-COVID, but hospitality has stabilised a little bit, so that would be a good thing. Maybe that's the tax cuts flowing through. Construction, I think, will require lower interest rates. Manufacturing trending a little bit higher, but only back to pre-COVID rates, and finance and insurance remaining quite low. And then wholesale trade, transport. I think all of these sectors are going to be influenced by what happens with Mr. Trump's policies. And again, if you would like to speak to someone at Creditor Watch and go into some of this data more and look at what it means for your sector and your business, we're going to have a poll at the end of the webinar that you could reply to that. The poll's just open. And then retail has picked up a little bit as well recently. So, and that fits with the story that consumers are under a bit of pressure as well. And I think as we go through the next little while, we'll see that that improve. So these are the conclusions for me. I think it's still going to be a bit challenging for the next 3 to 6 months until interest rates come down. The markets are now pricing it in April. They had it priced out in August, which seemed too late. I would be saying between February and May, we'll see the first interest rate cut. And we'll probably see 50, 75 to 100 basis points off this year. The tax cuts were helpful. The US election is uncertain, but I think with interest rates coming down around the world, inflation moderating, that we should be able to avoid a recession. The biggest concern there would be Mr. Trump's tariff policies, because they could be they're the uncertainty definitely at the moment. How much do they slow global trade, and what do they do in preventing central banks from further cutting interest rates? So I'm going to stop there. Michael, hand back to you. See if there are some questions on the chat screen.
Yeah, thanks, Ivan. That was great. Very insightful. A lot to take in. A lot of considerations there for businesses for next year. We've had just staying on inflation. We've had a question come in. Would you expect Trump's tariffs policy to lead to a one-off jump in inflation for Australia, or longer-term higher inflation rates?
Yeah, good question. It should be a one-off jump for particularly US inflation. So Mr. Trump isn't going to be, the tariffs are US tariffs, right? So US consumers pay those higher prices. Australia's government isn't proposing to put on tariffs. It may be the case that some goods, we see more goods sold to Australia, and it becomes easier to sell certain goods here. So the way that those tariff effects tend to come through to Australia would be that unless our government puts up tariffs as well, which we tend to not do that, is that the US dollar, the country that puts on a tariff, tends to see its currency appreciate. The US dollar goes up, the Aussie dollar tends to go down. So that's an effect that can flow into Australian inflation. To the extent the global economy is slower, that's an effect on the other side. And I think those would be the two primary influences. Slower global growth is not a good thing, but perhaps the currency is a bit softer than otherwise would be the case.
Great. So just staying on that
point about the one-off nature, and of course some of those tariffs went up and then came back down. And it doesn't affect services. It's only the manufactured part of the economy. So it's not the whole of the economy.
There seems to be a lot of interest actually in this question of the impact of the tariffs on Australia. But somebody else has asked about, a US-China trade war. How would that trade war between those two countries in particular impact global supply chains in terms of cost shifts and disruptions to manufacturing? And then what are the longer term economic effects on global trade flows potentially coming out of that?
Yeah, and look, it's a really, this is why I think this is such a key part of the next 12 months. Let's think about what happened when China put its tariffs on Australia. I think this is a real live example that everyone was familiar with. Now, there was a lot of doom and gloom when that was put in place. In fact, the Australian economy in aggregate, and again, those were selective tariffs on certain industries, but it didn't cause the Australian economy to go into recession. What happened for things like coal and barley, we saw price shocks initially, but then the trade rebalanced because there's a global demand for coal, there's a global demand for barley. And we found that there was a price impact, but eventually China had to buy its coal from other places. It had to buy its barley from other places, and it just changed where the supply chains worked. I think a lot of other things, there were wine and lobsters were particularly affected, where those were the biggest markets and the highest prices were paid into China. So that was a longer lasting effect. So some of it, you see things change in terms of the supply chain. Some China didn't actually put tariffs back on the US, on Australia for things like iron ore because it was important to China. But of course, when you're talking about the US and China, it's a much bigger deal, right? Because they're such big economies. But again, only manufacturing, which is a smaller share of those big economies. But it is going to be very complicated, and it will be interesting how that happens. It will be like you can't have Apple suddenly producing all their phones in different countries because they don't have the capacity to do that. Over time, it may mean that they're investing in factories in lots of different countries. And I think that is, people talk about deglobalization at the moment. I think re-globalization is a better term, where you end up trading more with countries that you feel comfortable with. Now, I think it's going to affect these supply chains uncertainty, pretty significantly if, and I guess it's an if, but he is promising he's going to do what he's said he will, but if they all come in and stay there for a while.
Thanks for that. Now, just looking domestically, you mentioned that there was some softness in the South Australian economy for businesses, but somebody has mentioned that the Business Council has named South Australia as the best place to do business. CommBank also rated it as a strong performer. So if you could just comment on your reasons for that, your position there.
Yeah, thanks for that question. And I should have said this. So in the little, on the sidebar, see that second bar? So this is just the NAB business survey. And what I've said there, South Australia and Tasmania are now the weakest. That data is very volatile. See how Tassie in particular goes up and down? South Australia can be the same. So it has been for a few months now where that is the report coming out of those data. I would say a little bit, take it with a grain of salt. Victoria, I think, is the one where clearly businesses are finding things most challenging with the government sector and the tax policies. And I think when I look at certain data, South Australia and Adelaide has been performing really well. You definitely very strong migration there over COVID, people staying in South Australia and even moving back there. There's been a lot of, there's been two big businesses, I think it was Deloitte and one other, that have got big offices there. So a lot has been going right in South Australia. So I'm not saying historically it's bad, but I'm just saying the business survey at the moment is giving a weaker read. So let's watch that over the next couple of months. As I say, it can be volatile month by month.
And of course, our business risk index data shows that Adelaide's the strongest performing capital city at the moment as well.
Yeah.
Just a question on small businesses, Ivan. Do you have any specific outlook on small businesses? Any trends or good or bad indicators?
Yeah, look, I think the NAB Business Survey, they do I think once a quarter they do a small business survey, but it's in this survey there's also small businesses, so they just grab out the small business story. The way I think about small businesses is not much different from the presentation I've given. One thing I didn't say probably as much is we talk a lot about consumers having a cost of living crisis. I think when I think about businesses and small businesses, I think about the cost of doing business. And I think there's also a cost of doing business crisis. Lots of things that consumers are finding are much higher in price, like rents, like insurance, like electricity, have also gone up very substantially for businesses. And smaller businesses tend not to have as much pricing power or procurement power as big businesses, but it doesn't mean they don't have any. And one of the things we saw during COVID was a lot of these price pressures happened because the supply chain had seized up and you couldn't get goods from overseas. So the import competition dropped a lot. So one thing I'd be saying to businesses now that borders are opening, and if there's a China trade war, you might be able to get some cheaper goods from China again, and look at where you procure goods from. And it's important to push back on suppliers and to ask to check out different suppliers and see where you can get better prices from. But I think in general, small businesses, it depends on the business, of course, which sector you're in, if it's retail, if it's discretionary retail, if it's food and beverage. I think it would be tougher, just as we're seeing in our data and in the overall data. Maybe one more, Michael.
Yeah, let's look. We won't get to them all, unfortunately, but we'll certainly. We've got your email address with the question, so we'll certainly send out a response to all the questions. Just to finish up, what are your expectations regarding business capex over the next 12 months?
Yeah, I think when we look at business capex, it hasn't been, it's been doing quite well in certain sectors. There's been a lot of state government spending on roads and infrastructure historically. There's a lot of investment in AI, in data centres, etc. So there's some good signs there. But I also think that the state government infrastructure spending, that some of those pipelines are starting to slow a little bit because of cost expenditure. It hasn't been quite the, I guess, harvest of green energy, renewables, climate change. I think people are finding that's not quite as easy to do as they thought it would be. And then, of course, commodity prices have come down a bit. So I think it's a little bit mixed. I think it's still something every business needs to look at. Are there productivity improvements that they could get from investment? But the indicators, like most of the indicators of the economy, are saying all right, but not disastrous and not very strong.
Great, thanks for that, Ivan. We've also had some questions come in about specific industries. Just to let you know, we pardon me, launched a white paper today on authored by Ivan with our 2025 outlook as well, in which he covers around 6 or 7 key industries. So we'll send that out to you with a recording of this webinar. So look out for that. That will cover all of your questions there.